All right, this ended up being a really boring week and pretty boring day. It wasn't necessarily so boring for our class portfolios. We actually ended up having a pretty decent day and a good week this week with the trades that we've done. And the selection of those trades are obviously what I share with you in the market outlook videos. But despite just this insanely low volume, small range, just extremely light and volatility hitting to extreme lows, about as boring as you could possibly be, there were some very interesting patterns going on and some very interesting trends that we need to be aware of in terms of how we manage our active trading going forward from here. So we're going to talk about that. And we have our trade idea on the stock that's had a it's a very popular stock. It's, a lot of people look at it. It's down to a pretty significant support level, showing some very strongly oversold signals that we might be able to take advantage of. We'll talk about how to do that with a strategy that will allow us a good risk-reward scenario without being so directional. So let's go ahead and get started. Today is Friday, August the 13th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the S&P 500 first, as we always do with the market forecast indicator. As you can see, we finished the week with a cluster with all four lines being up above the 80th percentile. So haven't had a cluster on the S&P this entire time, really, since this February 12th peak. There's been a few times we've been close. There we were close to having a cluster. All the lines were above nearly the 78th percentile. You can see over here we were really close to a cluster. Just a couple of them just barely below the 80th percentile. But this is the first time that they've all closed up above the 80th. This is the momentum line this time being the one that finally got up there. Last cluster on this little run kind of sparked a little period of volatility for the NASDAQ. Of course, for the S&P, it wasn't quite not really a significant decline in the least bit, but so we'll see if this cluster produces anything. And when you get a cluster at the beginning of an intermediate run, like when it's just barely getting above 80, it's actually really bullish. When you get one at the end of a run, nobody knows if it's the end of a run, but if you get one, and when you've been in the mature run, you can see we get closer to the end of the rally. So it's just a sign that kind of a little bit of an exhaustion move. Now, granted, over here you can see we continued into this divergent high point. By the time all was done, there's the cluster at the end of that particular intermediate run. So, again, we'll see if that turns into something more than that. You can see it in the weekly chart here. We didn't quite get a cluster on the weekly chart, though the near-term line is very high momentum. The small range kind of kept the momentum line still down to very low levels. So not quite the cluster there. And if you look at a monthly chart, but not the typical monthly chart, if you look at the options expiration cycles, you can see we're relatively close to a cluster on that one. The last time we had one was March going into that April expiration, and before that was November going into December expiration. You can see we just continued higher from each of those levels as well as all these others. So it's really that daily cluster that's pretty significant. The Dow Jones got a cluster earlier in the week. We got one here on Wednesday. The NASDAQ got a cluster last week. We've been kind of sideways ever since. Came very close to a cluster today. The near-term line was at the 77th percentile, so about as close as you can get there. And then, of course, the Russell 2000 is nowhere close to getting a cluster. In fact, the intermediate line actually turned back down today as the Russell 2000 rolled back over and closed below yesterday's low point. Closed back below the 30-day moving average, which continues to fall, and short-term sentiment rolling over as well into... So I need to move this over into... There we go, just a longer time frame into neutral zone, and now working its way down out of bullish territory down to potentially bearish territory. It didn't take too long in bearish territory over here, so we'll see how that continues to run. The momentum line suggests that we might bounce off of that. All these other deep momentum line drops you can see there we bounced off of. Here we bounced off for a day, then we bounced off of that low point, and then we bounced off of that low point for a couple of days. So we'll see if we end up bouncing off of this low point, very similar to what we've seen previously on the Russell. The Russell's been an interesting pattern because if you notice the two-line versions of like the S&P 500, you can see we continue to be pretty darn bullish here. The MACD is actually rolling up away from its moving average now. It's going to be hard for it to diverge significantly because it's already pretty high. The PPO, the stochastics is already pretty high. It's one thing to diverge when you're coming off of this low point and the stochastics is down, but the stochastics is already in the 96th percentile. So, but you can see all the lines kind of sitting on top of each other. Obviously, that's a much different situation right now for IWM. IWM's been interesting because previously we had been trading between the 17 and the 30-day moving average here without getting that good strong close above the 17 and the 30 at the same time. Well, we did break above the 30. We broke above the 17 and the 30, but you notice we weren't able to break above the 50. The 50 still above the 200, still converging, but you notice how we've been trading between the 30 and the 50-day moving averages now. And then today's drop here, dropping actually back down below the 17 and the 30 at the same time. So a little bit of a bearish crossover, crossing over multiple time frames with with all of these below the 50-day moving average still. So that's what makes the IWM a little bit more bearish from that perspective, with the MACD rolling over and potentially crossing back below its moving average and zero at the same time. Stochastics already crossing below its moving average, though it's still, both are still easily in the bullish territory. But you notice we're getting a crossover here like we did the last one that's not in the upper reversal zone, right? So it's avoided getting to a strong bullish level. Same thing with that MACD there. If you take a look at some of the other oscillators for the Russell 2000, you'll notice that again we were really we briefly got above 50, but we're back down below it. We briefly got above 100, but then back down now and flirting back with the lower half of the chart. So when we're bullish, we tend to get above 100, and then you don't really fall down below 50, especially below minus 100 for very long. And you can see, when we've been sideways, we've been above 100 and below minus 100 and going up and down pretty much all the time. But since this last break, this last little high point, we've been now down below 50 and using 100 for some resistance and 50 for resistance after breaking below minus 100 pretty easily and staying down there and breaking below 40. So it's been a little bit more bearish. We've also seen that too on the DMI, which is actually getting a little bit more bullish here on SPY, but not on IWM. In fact, we've kind of reversed course. The negative line bounced up off of 25 instead of dropping below it, and the positive indicator dropped back below 20. So we'll see if this is a very temporary thing, and if we bounce back up off of that level here going into next week, going into expiration week. Let's take a look at the trend strength indicators. SPY remains very, very strong from a trend strength level, well up above the cloud, well up above these lines. Again, not the case for IWM. IWM breaking back down out of the cloud. The cloud's been kind of holding resistance. We are still, above the green line crossed above the blue line, but still below the cloud, hence the weakness that we're seeing there. Also from a Bollinger Band perspective, we're nice and bullish upper quartile on SPY. IWM still is back, into the lower half of that chart, and you can see holding that point of control either as a center of gravity, right, not unable to really get going one way or the other, but also as a since we were below it, holding it for a pretty significant resistance. So you got that 50-day moving average, you got the point of control, you got that Ichimoku cloud, you got a lot of resistance sitting on top of the Russell right now, which puts pressure, right, which makes it the path of least resistance to the downside. In fact, if you look at that 200-day moving average for IWM, if you take a look at that now, here's that 200-day moving average. It's sitting right there at that 23% retracement line. So if and when we ever break through that level, I've talked before in the past about that. That would probably be a sign or a reflection of the floodgates being open in terms of risk aversion. The risk aversion has been more kind of, a little risk aversion here and a little risk aversion there and a little risk aversion here from time to time, but never a broad risk aversion. We haven't had that broad risk aversion trade, which is a mark of an intermediate decline, actual intermediate decline, since that September, October, where everything pulled back. Right? It's been very focused here since then, right? In the 9 months, going on 10 months now, since then, 9.5 months. So I've talked before about, this localized risk aversion trade turning into a broader risk aversion trade if and when the Russell 2000 breaks its 23% retracement level. Now it's even more so the case. I've been talking about that multiple times here. Now it's even more the case because the 200-day moving average has finally moved up to that level. You can see the orange and the blue lines. That gap between these two lines was the widest over here. Since then, we've been converging. And now we're up to that point where, we are trading between them, the 50 and the 200-day moving average. We've been doing that pretty much all since here. We got, above and below the 50. They've all been converging a little bit above the 50 now, a little bit below the 50, but all, while that 200-day moving average has been gradually rising to this important level. Just for some context, this is coming off of that November 24th low point, which is the last low point for IWM. The last low point for SPY was actually October 31st, and you can see where its 200-day moving average is actually at the 38% retracement, not the 23. So there's still quite a wide gap of long-term momentum between the 50 and 200-day moving averages that, of course, we are not seeing on IWM. You also see that being reflected in linear regression lines. If I were to go back, nice steady trend line here for SPY. But if you look at the 5-year chart for SPY, we're still grinding towards that first standard deviation channel. But for IWM, where we did get there earlier in the year, it's been pretty sideways ever since, and everything else is rising. And I mentioned to you the very, very long-term bullishness. I believe it was on the 10-year. I've shown you this chart before. For SPY, is up there near the second standard deviation channel, whereas for IWM, again, we were flirting with getting up there earlier in this year, really recovering and kind of this significant catch-up trade to where everything else was, because it was such a big move, so fast, so much so fast that we've been on such a significant consolidation pattern ever since. Let's take a look at the long-term candles now that the week is over with. You can see, again, very, very high PPO still, and a very good bullish candle still, and more than likely, because we're closing near the highs with this cluster, we're going to end up with another good bullish candle next week. The Russell 2000, not the same story. We're back below that 50-day moving average like we talked about. Very, very, we've been giving neutral candles previously to kind of transition. A very, very neutral candle here, and that convergence is still continuing as that gap between the 10 and 40 week exponential moving averages continues to shrink there. Again, kind of interesting to see the difference between the 40-week exponential moving average, which is not quite below that September, or it's a little bit below that 23% retracement level, whereas the 200-day simple moving average is actually right up there. So you can see the difference between the two lines when you're looking at a weekly chart versus a daily chart, and an exponential moving average versus a simple moving average. That exponential is really pulled up by the majority of the trading, which has been up above this line over the last 5-6 months or so. Let's take a look at the volume in the trading range. Here, if I go to this chart, the volume was 39 million shares trading. Again, very light all week long. It's been very light. The trading range yesterday got up to over 2.5 points. Today, back to less than 1 point. If you look at the R right here, 0.87 was the range. That's That's just abysmally low. If you look at the context here, again, the ATR is at 3 points, just under 3 points. The ATR is down to 0.65% of the current price. That is incredibly low. Like, again, to see for some context on where that is relative to where we've been in the past. So 0.655555. Throw that in there. That's where we're at right now. Again, to see, how long it's been since we've been this low. There's the pre-COVID levels. Here, let me do this here. The pre-COVID levels here, you can see how much of a grind that we had. So there's the 2019. We weren't quite below 6.5 until the very end of the year. And you can see we got down to 0.62 there. We got down to 0.58, 0.62 there. So, these extremes, we saw what happened, right? That's how quickly extreme lows in ATR can really play themselves out. Here's the lows. We were right around these levels for about a month going into October of 2018, and we saw what happened with the extremes at that point. Extreme lows in volatility, ATR and volumes, was 58 million shares trading. Relatively speaking, that was the average volumes back then. Obviously, the volumes now are about at 58 million again. But what's different about then and now is the VIX here has finished 5 consecutive days, or 6 consecutive days below 80%. Today, finishing down to 0.76 and a quarter. Like very, very, very low levels. Let me go back to that October 2018 time frame right over here, and you can see when we were right below there, we didn't have 5 days. We had just barely closed below 80% at that time. The VIX was at that day was at 11.5, so it was relatively low. We had been finishing with low levels. But at low double digits, the difference now is we're still above 15. Like, we haven't broken down to these. We're getting extreme sentiment down low from in terms of ranges and volumes and volatility, but only in the short term. Like, the VIX 3M is still above 20, or at least right around 20. Let's see, where did it finish today? Yeah, right above 20. So the VIX 3M is still above 20, even if the VIX itself is down to closer to 15. And then, of course, I've shown you the skew in the past, kind of showing this demand for the further out of the money trade, out of the money puts. And you can see it's jumping back up to 159. So bringing the 20-day average back up again. So it's after a period where the skew was dropping, but still at high levels, but not as high. It has come back in full force, back up to really strong levels, and that trend. This is actually. Let's see. Does this include today? Yes, that does include today. That has been updated, and you can see the trend here was also relatively strong today, up at 1.25. Remember, anything above 1 means that there's a more declining volume relative to the advancing volume than there was decliners versus advancers. So it kind of, again, shows the strength of the bearish momentum, even if we ultimately finished at all-time highs with a cluster, with an overbought cluster. So just some things to kind of keep an eye on, and just to kind of summarize this technical outlook here. Obviously we are still in a bullish trend. We want to maintain our stance to align with that, but that doesn't necessarily mean that we should be overly aggressive in our bullish trades. In fact, in our class portfolio here, we have we actually got our bullish deltas here, mostly coming from our inventory style trading, but you can see, like, even with negative deltas today, we actually had a pretty decent day overall from a profit standpoint, and from a P. And this is actually since the market closed. We are actually up a couple grand today on the portfolio, even though we had negative deltas. But we have significantly positive thetas, and we actually have positive vega, and the VIX was down, and we still were gaining. And so you can still position your portfolio to take advantage of bullish moves to the upside, but not be so aggressive. And that's why, as you can see here, like if I were to look at just my market outlook trades that we've been doing in this portfolio, there, I got some positive deltas, but not too strong. In fact, I think that's about maybe how much do I have at risk on this? 11,000. So we're looking at 1% is my delta relative to my total risk on all the market outlook trades that we still currently have on. But with that relatively directional positive delta, 1% is relatively directional. 2.5%, now I'm getting more directional. And 5% is full on, we are bullish. And so, at 1%, that's directional, but not strongly. And I've got positive theta, and I've got a very, very neutral vega. So if volatility does jump up high, it won't impact me very much from a P&L standpoint. And I'm still positive in my vega. So you can see, we can still be bullish, just don't back up the truck bullish in the aggregate of all your active trades with the type of posture that we have right now, maintaining the bullish posture but dialing back the directionality of our trades because of the risk involved with all the extremes in the sentiment that we are finishing the week with. It's one thing that kind of showing some things on Tuesday or Wednesday, but we are finishing the week at extreme lows in volatility and ranges and a cluster and all sorts of strong sentiment indicators right now. So that's kind of what I'm expecting. I expect that there will be some type of exhale. I mean, it's a lot of these types of patterns do result in exhales, and the exhale we get will be uncomfortable compared to what you may be used to. I don't know. But I doubt it will happen next week, and I doubt it will happen after expiration. I think we'll continue to grind higher and more of a positive divergence going forward. So we'll just continue to ride what trend we got, recognizing where weaknesses may be in the meantime, especially in small cap stocks, and kind of go from there until we finally dialing back the risk. So we're not, when that exhale does start out of nowhere, unexpected and out of nowhere, it won't be nearly as painful as if I was really kind of all in on the bullish side. So what do you think? Do you agree with that? Do you disagree with that? Let me know in the comment section below, especially if you disagree, as to why, what indicators or charts are you looking at that suggest why you may be a lot more bullish than I am, or that you may be a lot more bearish than I am. Alright, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, hit that thumbs up icon down there. That tells us two things. Number one, you liked our video today. And number two, that you want us to do another video again on Monday. Quick way to give us feedback and let us know you like it and then you want us to keep doing it. If you don't like it, of course, you don't have to watch. But you also don't have to click on anything either. And also comment down there. What did you get out of our videos today? What stood out to you in particular in today's video? What question do you have or comments do you have in anything I discussed? Post those in the comments section. Join our website on marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. We have a unique offer for our free subscribers to be able to check us out. So subscribe to be able to check out what that offer is. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, @DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, a few things that you can check out here. One of them being the Market Outlook live video that I do. Every day I do the Market Outlook. We did one today at 3:30 Eastern Time. This is where you get to it. You can get to it here or mouse over the Market Outlook at the top and click on Live Trade Review. That's what we do in that video. We review all the trades we've done in previous videos to see whether we should stay in them or get out of them. We also put on today's trade idea already in the live trade review video before the market closes. So it's something if you can check out here. Also our upcoming trading rooms that we have, including our Q&A session for premium subscribers tomorrow morning. You can see all the rest of our trading rooms up here. All of our paid subscribers, our premium and our plus subscribers, get access to these trading rooms, all the trading rooms, and the Market Outlook live videos Our premium subscribers get access to it for less per month. In addition to that, they also get access to our premium forums, class forums, and tools and resources that we have. So there's a lot that goes into the premium in addition to the lower monthly costs than what our month-to-month do. But all of our subscribers, like I said, get access to these trading rooms. Come down here to the bottom, click on this heart. It opens up a new tab. Hit that like button right there. Also hit this thumbs up icon. Opens up another new tab. Hit that like button there as well. Again, the more you do that, it helps us. It gets our content out to more people because of the engagements. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us from this page. All right, now let's get back to the charts, and you can see over the last few days, look at this discrepancy here from QQQ over the last few days, really from the last 2 days, and IWM. It's been a sharp reversal here. So let's take a look at the last, kind of zoom in a little bit on this past 5 trading sessions, and zoom into about a 5-minute chart here. So there's that sharp change. We had, a relatively positive week to date for small cap stocks here at the very end of the day on the 11th. But since then, you can see small caps went from a small gain down to a 1% loss for the week, and QQQ went from a small loss here and actually opened up the next day down. It actually opened up, but we were at one point we were down. At the end of that day, 0.5%, and we went down even more, down to almost a 1%. But instead of continuing to go down, the Qs actually rallied and finished the week positive, a 0.25% gain, while IWM. So to kind of zoom in on those last 2 days, this is what that looks like. Keep it at 5 minutes here. Gold and long-term bonds, real estate, Qs, all rallying. These are all the safety trades. And then on the other end of the spectrum, emerging markets, small cap stocks, commodities, all falling with the dollar, no less. The dollar has, in this case, has been kind of acting as a risk trade. If you take a look, let's take a look at the dollar, and you can see that. Give it a second to bounce up here. Look at that big move back to the upside. So, we're coming off of a cluster. We're moving back towards resistance we talked about before. To target this kind of 1885 area, those couple of, and if we make it through there, you've got some really strong Fibonacci resistance, or about the 1970 level. So that's the area we have been looking for us after holding support here, looking for it to peak. And again, obviously you can see, if that's the case, what that does from the other risk asset classes, like both bonds bouncing back up off of these lows. We were expecting that earlier in the week. A couple days later, and we do get that now back up above. I mean, we were below at one point in time here. We were below the we had gone down below the 17 and then below the 30 in successive days. But you notice we held the 50-day moving average, which is actually still below the 200. We held the 50-day moving average there for support, and look at that. We were below the 200. We bounced back up above. Let me just kind of show you that 200. There's that 200-day moving average. So we were just starting to recover to the point where we were back above the 200-day moving average, broke below it, but in one move today, we closed back up above the 200-day moving average, the 8, the 17, and the 30-day moving average, and that 23% retracement, right? This, since we've been retracing with that engulfing pattern there, we've been coming down. We hit about the 38% level retracement on yesterday, and boom, we bounced back up above that 23%, which again, if we hold that, would suggest that we are done retracing and we're moving back up towards the upside. Same thing with gold. Let's take a look at gold. You can see it had been very oversold earlier this week. We talked about that as being like too oversold, and look for it to jump back up, and that's what it's done now. It's moved back up to the 17-day moving average, and with all these lines all below the 200, so you can see how it's kind of all converged, but with a pretty significant divergence here, a higher low on the MACD than what we had on that low point. So I think there's an opportunity for gold to take advantage of this weakness in the dollar. So not your typical safety trade, but when gold and bonds and large cap tech stocks all move together in the same direction, as you see here, getting back up above the 8 and 17 and 30-day moving averages, then that's a bullish sign for this kind of risk off trade. You can see the MACD had converged. We had some positive convergence on this relative strength, looking like we might turn back up here without breaking below zero, while the PPO is still positive and rising. And you can see the CCI for the relative strength and holding the negative 100 for support and bouncing back above the midpoint of the chart. And then the RSI holding the 50 level for support and bouncing back up towards 60 and getting back up into bullish territory. So again, that's kind of a risk off type move, and you see that reflected as well in the sector rotation. Let's take a look at the last 2 days since this safety trade kind of really kicked in gear this week, and you can see that we have XLK, XLV, and XLRE, and you have staples and utilities also up here. I mean, that right now is your safety trade. All your safety sectors and XLK. That's your safety, all outperforming, 0.75% or higher in the last 2 days alone. While down here at the bottom, you have energy and industrials and financials, discretionary, along with materials, all of your cyclical areas all struggling. And they had been bouncing. When you look at the 12 grid, you can see that these areas have been converging, XLK getting a cluster today, but XLY, XLC converging after getting their clusters. But look at XLF. I mean, look how bullish it got. You're going to get some convergence on that when you're that extreme. XLI had a cluster earlier this week, also well above, and you can see XLB well above its moving average. And XLE is hitting resistance and rolling over, while your safety trade is really taking off. Utilities and staples up to 3-month highs. Real estate had been really bullish and converging, and XLV still strong. So your safety trade down here at the bottom really taking off, and your cyclical trade kind of slowing down. And if you take a look at the 12 grid here for these main, well, let's take a look at this chart first over the last 2 days. Same concept to see this risk aversion trade, this kind of very short-term risk aversion trade. You can see how Germany, India, Italy, France, so your European developed markets doing very well, outperforming the U.S. On the bottom, Korea, which is a reflection, its economy is a reflection of the global economy, really struggling. And you can see Brazil and China really struggling as well down this last couple of days. So they're bouncing back down. Now let's take a look at their 12 grid here. There's China holding some resistance. There's your developed markets, Europe especially, kind of rolling up, looking very strong. Look at Korea down at the bottom, just dropping like a rock. That's not a good sign for economic expectations, because when you look at South Korea and you look at like the chip sector in particular, let's look at the market forecast for the ETF that tracks semiconductors, SMH. You can see we've been down, and one of the biggest names in that sector is really starting to fall off and break through these lows that we have, Micron among others. And you can see the weakness in these areas reflecting in South Korea as well, and that's a reflection again of global risk appetite. EWY had been pretty bullish here when the Russell really kind of took off early in this year, kind of peaking at the beginning. But if I were to go back, let's go 5 years, you can see the big move off the COVID low point, getting you through the pre-COVID highs, and then really through the 2018 highs, well up above that. So very, very strong. And that's, again, a reflection of what the Qs have been doing, getting well up above. They were already up above their 2018 highs. The COVID low was almost above the 2018 highs. It was. The COVID low was above its early 2018 highs, and you can see the rally. But EWY wasn't, right? Korea wasn't. It was, there's its pre-COVID highs in January of 18. It just barely got up above that over here, very similar to like the Russell 2000 and like the Russell 2000, been going sideways since an early peak this year, and now really kind of breaking down below support. In fact, when you look at the Bollinger Bands with the volume profile, you can see here, and let's go 2 years, again, very similar to the Russell 2000, this idea of strong, fast move, creating a big gap in volume. So you look at IWM and you see something very similar, right? So EWI might be showing us what we're about to see in the small cap index and the broader risk appetite trade as a whole, now that it's been breaking down into it, like I said, a very significant level of very, very little volume. So very easy for it to fall in trade anywhere in this area without meeting any resistance or support in either direction. All right, that takes us to our trade idea of the day now, and this stock has actually been on its own little intermediate decline. If you take a look at Roku, we've been dark pink shading in a red line. We're well below the moving average. In fact, when you look at how far below the moving average we are, you can see it's pretty, like, we're pretty more bearish than what we have seen in a while for the stock. When you take a look at, we're down 14% below 30-day moving average, about as far as we got down through there on that earnings announcement. And then over here, we were about 20% below the moving average, but that was after a much longer bullish run. You can see we had a pretty significant bullish rally there. In fact, when you look at it from a market sentiment standpoint, here's our market sentiment run coming off of the COVID low point. So here I go to right there. You've had this big long rally here. Let's get rid of this line for a second. So this big long rally from a market sentiment basis, you had a brief little move below, so an intermediate run, another intermediate run. This was in May of 2020, right? And then of course we got the February-March weakness that we had in the NASDAQ that pulled back there, and you can see it actually continued down into May on the secondary intermediate decline for the NASDAQ into early May into this about the 50% retracement. You can see pretty much holding the 38% retracement level for a support. A little bit of a kind of a inverse head and shoulders type pattern here, and then breaking out with a cluster to the upside, and we started to get bullish. We diverged a little bit to the downside. That pushed us through the 23% level down again, almost to the 38% of this big long run that we haven't, we tried to get it going again to the upside, but not quite. You can see this is that intermediate rally here coming off of this low point where the intermediate line hit the low in bearish territory and then rallied up eventually to this divergent high point here. You can see now where these clusters, 3 in a row, are sitting right on why we kind of stopped here. This is where the low end of the current intermediate run that we've retraced, the very strong support from a retracement standpoint. If you look at it as well on the Bollinger Bands, there's a really strong volume node support right at that level as well. So a lot of clusters going into some pretty significant support levels for Roku. Here's the cloud, which is just a little bit below the cloud. We were kind of holding the cloud for support the last couple of days before this particular move. If you take a look at the directional movement index, and you can see, okay, that's a pretty high. I mean, it's about as high as we got in the negative index as we did over here, coming off that low point. Of course, the positive is actually a lot lower. In fact, we haven't been this low in the positive indicator since that low point that we had here. So these last two lows, we kind of have, very similar levels on the directional movement index. We do have a rising ADX, but it appears that this level here is kind of an extreme, especially when you look at like all these red bars that we've had, all these down days with very minimal up days in between. What that's done is brought the historical volatility up higher, but you notice that during this big significant downward move, we didn't get a jump in implied volatility. In fact, implied volatility is actually lower because of the earnings. It was ramping up into earnings. We're off of the earnings, and now we're in this scenario where historical is above implied. You notice that usually leads to fewer red bars when we're in that scenario. We start to get more and more green bars coming out of this. Over here you can see again this scenario where the historicals above implied, we get fewer red bars and a lot more green bars. And that's kind of the expectation I'm looking for here. Not as wide as the gap as we've seen, more similar to this one, but the idea is very similar. You can see historical volatility has actually been gradually forming lower highs every time. I think we have an opportunity for one last leg to the upside. We did this bullish trade a little differently than what we do normally. We came to the at the money strike and we sold a put spread at the money. So what that did was it allowed us to, so we sold the 360, bought the 355. It's a reward of $1,000 for about $1,000 of risk. So now you notice typically we're willing to lose what we're trying to make. We're trying to make $1,000. We're willing to lose $1,000. We actually are trying to make more than we're willing to lose. So it gives us the ability to kind of take a maximum loss on this trade. Obviously we're not, because look how big of a drop it would have to take. If we were to drop back down below these support levels, then we'd know, okay, we probably don't want to be in this very much longer. It's not going to hold support. You expect support to hold until it doesn't. And if it doesn't, then you can see it's going to be very easy to get out with, say, like a 200. Like if we could break down to 335, which would be down into this area, you'd be breaking support. All those layers that we talked about that are lining up in this spot. The other thing is the 200-day moving average we are sitting right on. So all these layers of support here, we have a good chance that if we don't hold these and we break down, then we can easily get out with like a $250 loss or a $333 loss. Well, now a $1,000 gain to our $250, that's a 4-to-1 risk reward scenario. So I'm getting a really good 3 to 4-to-1 reward to risk ratio on a put spread, on a short put spread, which typically we try to make $1. We're risking $3 to make $1. Now here's a setup where I might risk $1 to make $3 or $4. With this bounce off of, and again, it doesn't have to go up very much. It doesn't, if I were to do like a long call vertical spread, we'd probably have to get it up to 440 for us to get a good reward. Here, I just need it to stay above 360. As long as it stays above 360, I can get a really good reward for the risk that I would be taking if we were to break this support level here. Alright, so that wraps us up for today. You've heard from me now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. All of our subscribers, even our free subscribers, have access to that. So let's keep this conversation going. Open up in a thread with any questions or comments you have. Reply to anybody else's threads. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Like us on Twitter and Facebook too. Comment on the video. Have a great weekend, everybody, and we'll see you all next week.